Hi, and welcome to New Markets Tax Credits for Private Equity Groups and Family Offices. My name is Pete Byford. I'm a senior manager with Tax Advantage Group by Cherry Bekaert, and I'm joined by Scott Sheffey, who's a manager with Tax Advantage Group by Cherry Bekaert. Today, we're going to talk a little bit about the New Markets Tax Credit and how private equity and family offices can take advantage of the program. So starting with what they are a tax credit program designed by the federal government to be a corollary to the low-income housing tax credit and drive economic advancement in low-income communities. It's administered by the CDFI fund, which is a department of the U.S. Treasury. It's a highly competitive program because it is a public-private partnership, which Scott will talk about in a moment. And there is a limited supply of credits in any given year. But the ultimate goal is to create economic development in low-income communities, whether that's attracting and retaining a skilled workforce or bringing new goods and services to the community. That is its ultimate goal. So Scott, why don't you talk a little bit about how it works?
Yeah, thanks, Pete. As you mentioned, the program is largely policed through its highly competitive application process, which is a good thing to keep in mind as we go through these steps. Now, through that process, the community development entities apply to the U.S. Treasury for allocations of tax credits. Once granted those tax credits, those CDEs then have to find qualifying businesses that would read well on the highly competitive application. Those projects typically are generally catalytic in their social nature. Those CDEs, once they locate those projects, will then have to find third-party investors that will receive that 39% tax credit, as well as lenders to leverage the transactions in order to facilitate the entire project. Now, those proceeds are used then to fund qualifying projects, and typically those projects will have special rates and terms associated with them.
Gotcha. So the project is not getting credits itself, it's getting cash from the sale of credits in the new market structure.
Correct. It is getting generally more flexible terms than it may otherwise get with traditional financing.
So walk us through how those impacts work.
Yeah, what that looks like, as I mentioned, 39% tax credit. So that third-party investor is going to pay some reduced amount for that in order to receive its adequate return. So that typically looks about 17 to 20% of tax credit equity would go into the project, and it's paired, as I mentioned, with that leveraged debt or leveraged sources of 80 to 83%. And then, as I mentioned, those combine to give the project benefits of, for example, subordinated loans, low interest rates, interest only for 7 years. And typically what we see is that a portion of that new market tax credit subsidy is typically left with the borrower or not repaid at the end of the 7-year compliance period.
Gotcha. So they get cash subsidy on the front end and then aren't required to repay at some level on the back end.
Correct. In our example, we're using a $10 million allocation amount. That allocation amount creates a 39% tax credit. So on a $10 million example, we end up with $3.9 million of tax credit. As I mentioned, that investor will purchase that at a discount. And for our example today, we will use a 75 cent credit price. So the resulting amount of tax credit investment is $2.925 million. Now, there are costs and fees associated with closing a new markets deal because of the technical structure. And typically those fees and costs are typically about 10% of the new market tax credit allocation amount. So we result in roughly $1.925 million of net spendable cash that the project will receive.
Gotcha. And they can spend that on the front end on whatever they're doing with their project.
Correct.
Okay, so that's a pretty good benefit. Let's talk about where you can take advantage of that. And the program starts with geography. It can only be used in census tracts that qualify because they're an area of higher distress. At the base statutory level, that's elevated poverty of 20% or higher, or depressed median family income at 80% or less of the average. Lots of other characteristics and lots of other things to punch that up a little, but those are the baselines. Additionally, because as Scott said, these are highly competitive program, or it is a highly competitive program, and these CDEs are trying to win more allocation to finance more projects year after year. They're going to be looking for demonstrable, quantifiable community impacts. Oftentimes that is new jobs created, higher wages paid, full-time benefits available, health insurance coverage, those types of things. And then of course, we've got a but-for analysis. This is a federal government subsidy, it's gap financing. So it is designed to come in and fill the last bit of the bucket. And so the project needs to be able to say, but for new markets, we wouldn't be able to create these community impacts in this geography. And then additionally, because these community development entities, as Scott said, are writing these applications, they want to talk every year about new projects they've financed. So there's this timing aspect of pulling all of your other financing together, getting your design and development work done, getting everything pulled together, and timing up with when the CDE has money available to finance a project. So Scott, why don't you dig into a little bit what you can use these things for from a private equity and family office perspective?
Yeah. The types of projects that are typically financed are business acquisitions, some working capital associated, typically with mechanical or industrial type projects, machinery and equipment, or real estate development. Now, as you mentioned, you want to show a measured community impact with the project. So on a real estate project, there is actual statutory requirement that 25% of the new market tax credit amount be used for substantial improvement of the real estate. Similarly, but not as statutory, the projects, the working capital or machinery and equipment or business acquisitions, you do want to show some measurable growth of the business because of these tax credits, whether that's increased output or larger operating footprint of the factory or whatever may have been financed.
Excellent. And as we talk about governmental funding programs, they always come with some rules and some catches. And so we're hitting a couple of the high points here. First, the investor earns their credit over a 7-year period. So there's a 7-year compliance period where the ownership and holding timeline for the project has to be in place for at least 7 years. And then of course there's reporting. The CDEs need you to report back the community impacts you're having, the jobs created, wages paid, expanded output, whatever that is. And then typically they'll be looking for the same type of financial reporting that any lending institution would be looking for. As we said, because of the design of the program and the pairing of other sources of capital with new market tax credit equity, there is some significant structuring involved. And so equity investors and lenders are going to have to participate in that transaction. And sometimes that's easy, and sometimes that takes a little work in explaining in how they can participate in a new markets transaction. And finally, these investors have a very low risk of losing their tax credit. But if something goes wrong in the compliance landscape, again, very low risk, but high damage. If it does go wrong, the investor loses their entire 7 years worth of credits. And so typically they're going to be seeking an indemnity or a guarantee of their return from somebody involved in the project, whether that's an entity or an individual is deal by deal, but they will be looking for something like that. So that's a really quick overview of the New Markets Tax Credit Program. It can be a really effective tool for family offices or private equity groups that are underwriting transactions that definitely work, but could use a little bit of additional gap financing to make them really hum. Scott and I are always available and happy to talk about how a project might fit into the new markets landscape, either from a geography or an impact or a financial standpoint. So give us a ring, shoot us an email, and we'd be happy to connect. Thanks so much for your time today.
Thanks, everyone.